7 stock market mistakes that must be avoided at all costs, okay? That's what we're getting into today. If you're new here, welcome. I'm Austin. I'm a co-owner of cloudmusicsuite.com, and on this channel we talk all things money and personal development. So if that sounds up your alley, go ahead and subscribe. As a thank you for subscribing, I'll show you this picture of my beautiful kitty cat who's right next to me taking a nap right now. All right, hope you enjoyed that. Thank you for subscribing. All right, let's get into this thing. 7 mistakes. First mistake that I see is people waiting until they have a certain amount of money to invest, okay? I want to wait until I have $10,000 to invest because I want it to do something for me. I want to wait until I have 15,000 or 2,000 or whatever the number is. Whatever number you have in your head, stop, okay? Get rid of that number. Just make your first investment. And I've told people, just go $15, $15, $30, $50, some amount of money that you'd be totally okay if it just evaporated. You never saw it again. Because there's so many reasons. But number one, you are going to make mistakes whenever you first start investing. I promise you're going to make mistakes. No matter how many YouTube videos you watch and how many books you read and courses you buy, dude, you're gonna make mistakes. You need to start now so that those mistakes that you make are not like colossal, absolutely decade crushing or life altering, okay? When you make a mistake with $100 or $150 or $300, it's not gonna ruin your year. It's not gonna ruin your decade, okay? It's gonna ruin your day, maybe your week, maybe your month, maximum. So make those mistakes in low risk environments in the sense that there's not a lot of money to lose because you're gonna make mistakes when you first start no matter what. So if you wait until you have 10 grand, you don't wanna make mistakes with 10 grand, okay? You wanna make mistakes with $100 or $1,000 or something like that. So not investing until you have a certain amount of money, that's number one. We gotta start now. You gotta live, you gotta learn, and you gotta get better with the small amounts of money now so that you don't make mistakes with big amounts of money later, all right? Mistake number 2, not knowing what you own in the stock market. Good God, if you can't tell someone within, let's say, 2 minutes or so what the company does that you're owning the stock of, you have no business owning that stock, right? If someone says, oh, I own, whatever company, I can't think of a fake name. I own fake company over here. And you're like, oh, what does fake company do? And they're like, I don't know. You'd be surprised at how many people have no idea what even business they're in, like what industry they're in, what their business model is, how they make money, what product they sell, what service they sell. People know almost nothing. They're like, oh, look at this stock, it was going up and it's probably gonna keep going up and that's super sick. And then it doesn't go up and they're like, whoops, sell for a 30% loss. It's super unfortunate. So you gotta know what you own. Like, go look at the investor presentation. Go look at their website. Click around on whatever company's website this is. Go to their investor relations page, listen to some conference calls, figure out, do they normally do US business only or they normally do international business? What's the expansion opportunity? Figure out stuff about the business. When you're buying a stock, it is not just a ticker symbol with some numbers. It's a company. You're buying an ownership in a company. So you need to decide, is this a company as a business decision that I would feel good owning a piece of? Am I confident over time that this company is going to grow their revenues and grow their earnings? If you don't even know what the company does, dude, how confident can you be that they're going to grow their revenue and grow their earnings, okay? So not knowing what you own is definitely number 2. Absolutely going to shake people out of stocks whenever they go down. All right, number 3, not investing at all because it's too risky, okay? There is way more risk to not investing at all than there is risk in the stock market, in my opinion. Yes, you can lose a lot of money. You can potentially lose everything whenever you're investing in a stock. But if you are knowing what you own, you learned whenever you had low amounts of money by getting started soon and early, right? And you did all the research work, right? You figured out the financials. You figured out, okay, here's their expansion opportunity. I feel like this is the total addressable market. It's going to grow over time. This company has a great management team. They're a proven management team, et cetera, et cetera. I understand the business model. I can see how this could grow in future years. If you're doing all that research work, that de-risks pretty much the whole process of investing. Yes, there can be volatility, but volatility does not mean inherent risk. If something goes on really high runs up and really low dips, that doesn't necessarily mean it's riskier. It just means more volatile, right? Anyway, I'm going off on a tangent, but not investing at all is way riskier than trying to live and learn and get better by buying stocks or even just buying index fund ETFs. Like if you're worried about risk, buy an index fund ETF, buy the S&P 500. That is very low risk. Okay, that's a lot less risky than never growing your wealth at all and just trying to save your way to financial freedom, which is probably not going to happen. All right. Not investing at all is number 3. Number 4, selling your stocks, some of them or all of them, whenever the market is on a downturn. Every 5 years or so, there's something called a bear market. A bear market is where the major indexes or indices go down 20%. All right. That's a big move down. But let's remember, those sometimes comprise the biggest of the big dogs in the market. And the biggest of the big dogs normally don't dip all that much. So if the entire market's dipping 20%, if you're an individual stock investor, some of your stocks are going to be down 30, 40, 50, 60, 70, 80, 90%. No joke, not lying. Like this is actually a real possibility that you need to be prepared for, okay? If you bought a great stock at a fair price and you felt good about buying it at $100, the whole market dips 20% and your individual stock dips 30%. Now you can pick up that same stock for $70. Why would you sell it for $70? You felt like it was a great buy at $100. Why would all of a sudden you feel like it's a bad situation whenever it's 30% cheaper? You get what I'm saying? So what we want to do instead is, if we have a lot of confidence around these stocks and we did all the research work and we listened to the conference calls and we listened to the investor presentations and we look at the financials and we figured out the total addressable market, then we're going to want to buy more when it goes down. Okay? As they say, buy the dip, right? You're going to want to buy more. So if my $100 stock that I felt like was a great deal dips to $70, dude, I'm loading the boat. Assuming nothing about that company's financials have changed, which normally they don't. Stock market goes up and down for so many different reasons. And it's not because one stock's earnings just dropped a bunch, right? So if the growth story is still intact and the company's still in a great spot and the company's still getting more and more stable and more profitable, as it dips, you better buy more. Definitely don't do the opposite and sell when we dip, okay? Number 5, short-term trading. Trying to get in and out of stocks. Almost everyone loses when they try to trade. If for no other reason, just for tax purposes, please don't trade, okay? Trading means I bought a stock 1 month ago and I'm trying to sell it 1 month from now. The tax treatment on short-term capital gains, meaning when you sell a stock, you have to pay taxes on that, if you didn't know that. So the tax rate is your tax rate, your income tax rate. And if you make good money, then that could be a really bad situation. And then if it's long-term gains, potentially 0% if you're a low earner, or 10 or 15% on those long-term capital gains. That could be less than half of your effective tax rate for your regular income tax if you just held the stock for 1 year for long-term capital gains rate. So just for that reason alone, I don't want to pay more taxes. I'm not going to be a short-term trader trying to get in and out of stocks. Number 2, you don't know where the stock market's going. I don't know where the stock market's going. Warren Buffett doesn't know where the stock market's going. Michael Burry doesn't know where the stock market's going. If anyone tells you that they know that the stock market's going to do this over the next 6 months, run away. Run away and never listen to a single word they've ever said again. There's many people here on YouTube who believe and act like they know exactly what's going to happen with the stock market. Run away. Okay? No one knows what's going to happen in the short term in the next 3 to 12 months. That's my opinion. It's just no one knows. So if they act like they know, they're delusional. All right? You don't know either. Don't try to get in and out of stocks. It's a losing game. Winning over the long term, much easier than winning in the short term. We'll just leave it at that. I could make a whole separate video on short term versus long term investing. All right, number 6, taking profits too soon. Taking profits too soon is a real thing. I did this myself when let's say I buy a stock, I feel very good about it. I assume over the next, let's say 5 to 6 years, I'm gonna get 100% return. I'm gonna double up my money. That'd be great. But I got a quick run up and let's say I got like a 40% gain in 1 year. That's great, right? So I sell out. I absolutely did that when I was earlier on in my investing journey, and I'm still sometimes subject to that today. It's hard to see the 40% profit gain, especially when it was like in a short period of time, and not take that profit and flip it into another stock. But if you have a 100% gain possibility, like a 2x possibility, or even a 3x, 4x, 5x possibility over 7 years, 40% is a joke. Okay, if you really feel like you have a stock that's going to grow substantially, your revenues and earnings over time, and you're going to be able to ride this growth story out to a double up or a triple up or a quadruple up, or potentially way, way more than that, which is definitely possible, selling for 20 or 30 or 40% is a joke. Okay, so don't be too quick to take profits. Let the winners run. As long as the financials are still getting better and the company is firing on all cylinders and they're doing their thing and they're growing, beating expectations, growing at a substantial clip, making their earnings better over time, so they're becoming more profitable, stick with that company. Okay, don't put your money with someone else. I don't know if it was Peter Lynch or Warren Buffett. One of them said, what's the best stock to buy? People would ask them all the time, and they would say, one that you already own. One that you already own is a stock to buy because you already did the research work. You already understand. There is not a million winners in the stock market, okay? There are some winners and there are some huge winners. And if you feel like you picked a huge winner, don't settle for a 40% profit, all right? That said, number 7 is gonna kind of reverse that a little bit. Number 7 is, this is a mistake, number 7, not having a time horizon or a goal price over time that this stock is going to get to that you're buying. So not having a time horizon for each stock can be worrisome because you might fall into this trap where you get a 20% increase in a year and you're like, well, why don't I just take my profit? This is doing better than I thought it would this year, so let me just sell out. But if you've already written down on paper or in your iPhone notes or whatever that you want to hold this stock for the next 5 years, and here are my reasons why, because I feel like they're gonna take more of the total addressable market. I feel like they're going to be able to grow their revenue this much is going to hit the bottom line in terms of earnings per share and net income. Stick with it for 5 years. You're highly more likely to stick with it if you've written down and you said, I plan to hold this for 5 years. All right, then you can see the growth story play out. You're less likely to sell for a small little profit. Small little profit's fine, but remember, if you have a time horizon of 5 years and you're expecting a double up, you need to hold that stock for that 5 years and see that play out. Maybe you're wrong and you only get a 50% gain. Maybe you're wrong and it goes way better than you thought and you get a 300, 400, 500% gain. If you've been in that situation, it feels great. It feels really, really good to be, you were sandbagging your numbers. You underestimated this company that you believed in. That's a great feeling. And then the other one is not having a price target. So some stocks that I buy, my goal with them is only to get, let's say 50% over about 3 to 4 years time. So these are kind of slower growers, very established companies, normally dividend payers. I'm looking to collect that dividend money, buy this undervalued asset and ride it until it gets back to being fairly valued. And I would say that's probably going to be normally around a 50% gain for me. So around that 50% gain time, now I reevaluate and say, is this stock fairly valued now? Do I still see a lot of upside? Because at that point, I can just take a sec, reevaluate and say, no, I think this story has played out. I'm going to sell out, take my 50% profit because that was my goal anyway. Or I can say, well, yes, that was my goal, but I see a lot more upside here because the company's in a lot better position now. So I see another 50% from here, and maybe I can even turn the stock into a double up. So those double up type stocks, those are what's going to change your wealth trajectory over the long term. 10, 15, 20% here and there is cool, but it's really not going to make the huge difference like you're looking for from those big winners. So those are the 7 stock market mistakes. Hope you got some value out of this. If you did, comment below, hit the subscribe button. I greatly appreciate it. Have an amazing day.